All right, we're live. Apologies for the delay there. We had a little technical error, which is pretty standard. I think LinkedIn or whatever system we're using is still on holidays, but I've dropped my kids at school this morning. They are back, which is fantastic news. And I've got a fantastic session for us today. I've got Alice Rue from SMB Advisory and also Prue Greenfield from McPherson Kelly Lawyers. And what I'm going to do is I'm actually going to get them to provide a little bit of an introduction for themselves and a bit of background that will lay the foundations for today's discussion, and will give you confidence in why Alice and Prue will do all of the talking rather than myself, because they are the experts when it comes to DPN and restructuring and insolvency and everything else that comes around that huge industry. So, Alice, I might start with you if you want to provide a bit of background on yourself and what it is that you do.
Sure thing, Patrick. Thanks for that. Thanks for the intro. Alice Rue is my name. I'm a partner at SMB Advisory. We are a firm of chartered accountants that specialise in distressed business advisory. I'm a liquidator and a trustee in bankruptcy myself. We've got 3 liquidators in the firm and 2 trustees in bankruptcy. So I deal with insolvency day in, day out, insolvency, restructure, business advisory work. I have been doing it for a little bit over 20 years now, and it's my first love and my bread and butter. So dealing with these matters, and especially matters to do with the tax office, is something that I deal with quite often. May have a lot of appointments where the ATO are the petitioning creditor, both in bankruptcy and in liquidation. So they're an organisation that we need to sort of, deal with a lot, have it, our interface and our little ecosystem. And DPNs is something that we're finding is really affecting a lot of different businesses and a lot of different stakeholders at the moment. So I'm thrilled to be here today. Thanks for having me.
Fantastic. Thanks, Alice. Great to have you with us. And Prue, over to you.
Thanks, Patrick, and hello, everyone. I'm Prue Greenfield. I'm a principal at McPherson Kelly. We're a mid-sized commercial law firm dealing in a lot of different areas, but in particular, I practice in the litigation and dispute resolution area. Have practiced for over 20 years in the areas of insolvency from a legal perspective, debt recovery, working in the credit management area with a lot of credit managers, T's and C's, that sort of thing. I do franchising, shareholder disputes, obviously seeing a lot of director penalty notices and what's currently happening with the ATO. So we advise a lot of directors and deal with a lot of accountants as well in helping their clients in this space. And very excited to be on today and to discuss this topic, which is very much in the media at the moment.
It is a hot topic, that's right. And a quick intro from me. I'm Patrick Coughlin, the CEO and one of the founding employees of CreditorWatch. I've been here for 12 years, and I will be mediating today. Moderating, actually, I should say, but mediating suits the topic anyway. And CreditorWatch, just for those who are maybe not familiar with CreditorWatch, is a commercial credit reporting agency. We provide a range of credit reporting, credit risk management tools, data, reports, ratings, etc., etc. So if you are interested in anything credit related around risk, please jump onto creditorwatch.com.au, but that's not what we're here for today. We're here to talk about director penalty notices, and what I'm going to do is I've got a few questions that I've got lined up for Alice and Prue, but anyone who is signed in and listening today, please don't be shy, feel free to ask questions, and we will get to them in due course. But really what we're after today is a really nice discussion, informal in nature, to talk about, of course, director penalty notices. I think we're talking about, how yourselves, but also companies in general, can work with the ATO, because the ATO is very much interested in working with businesses of all sizes, and they know what we're up against at the moment, particularly through COVID. We saw that they were, I would say, very, very supportive, and they continue to be so. And I think that we'll continue to see that for the foreseeable future. So let's jump in. Alice, I'm going to ask you, what is a DPN?
Thanks for that, Patrick. And one thing I just wanted to add as well is that Prue and I did a webinar for CreditorWatch, I think back in August. I might
Yeah,
be.
I think it was. Yeah.
Was it last August? And that was really quite technical. And I believe, Patrick, that's on your sort of the CreditorWatch website as well under webinar. So if there's a really technical sort of aspect there, I think we spent about an hour talking about DPNs that, people wanting to head across to the CreditorWatch website and have a look at that. We can do that as well. But as you said, this is sort of more of an informal chat around, things that we've been seeing and what DPNs are. But director penalty notices are exactly that. They're a notice that are issued from the tax office that basically allows the corporate veil to be pierced. So normally a director isn't automatically responsible for the debts of a company. The company is a legal entity in its own right. However, in relation to the payment of, or the non-payment of PAYG, SGC and GST, the tax office has the ability to issue a notice, if that's been unpaid, to a director that upon the expiration of 21 days will make the director themselves, the individual, personally liable for the debts of the company. And I think sort of long and short, that's what it is.
Beautiful. And just Prue, if you could just talk through that process. A lot of directors out there probably not had to have any real engagement with the ATO, and I recently did my AICD, Australian Institute Company Director course. After day 2, I think it was, when we did legal, at the beginning, the person who presented asked who wants to be a director. Everyone put their hand up. At the end of the day, who wants to be a director, and a lot less hands were going up, because I don't think people are really aware of the legal side of things and the regulatory hurdle. So maybe just a little bit of a process around, how and when a DPN is obviously issued, and then if it's not responded to, what happens from an insolvency perspective.
Yeah, sure, Patrick. It is quite involved, I guess, from start to finish. But what happens at the beginning is the ATO has been sending out, or they were last year and still are, a lot of warning letters. So that's a pre-letter prior to receiving a director penalty notice to say, you have an ATO debt for one of those things that Alice mentioned. If you don't deal with this and engage with us, we're going to, we may serve you with a director penalty notice. So the idea at that point is, obviously directors need to take that seriously, because that is an opportunity where they can enter into a payment plan. And we'll discuss a legal case where you now can't do that at a later stage. So it's a really good opportunity at that early stage to engage, because the ATO are, willing to work with directors and deal with all, obviously, this unpaid debt that is sitting there from COVID, essentially. So that's the early stage. If there is no engagement, then a director penalty notice can be served. And there's a lot of things around that as to what you need to do to ensure that you actually receive it. A couple of things are to make sure your address on the ASIC register is up to date. So when you do a company search and then you look at the address of the director, if that's an old address, you're not going to receive it, and that's quite serious. And also to recognise that the 21 days that is running on that notice starts from the date of the notice. So not the date you receive it, but could be a week later, and you might have 2 weeks to deal with it. And then your options, it depends on the notice. There is a non-lockdown DPN or a lockdown DPN. So a non-lockdown DPN, and in our webinar that we presented, which will be on the CreditorWatch website, there's examples of what the different notices look like. But the non-lockdown DPN is where you have lodged your returns with the tax office, but you haven't paid, essentially. So then they can say, okay, you have 21 days to either pay the debt, or one of the 3 options now is only enter into liquidation, administration, or a small business restructuring regime, which Alice can go into more detail. So they're the only steps that you can take. Previously, you could enter into a payment plan, but now, because of a recent decision, which we'll just call the Clifton decision, they're the only steps you can take. So if you can't pay it, you need to get advice from a restructuring practitioner such as Alice. The other notice that can be received, the DPN notice, is a lockdown. So that's when you haven't lodged your returns and you haven't paid. And then the only option there to remit or take away that personal liability is to pay it, essentially. So it is quite technical, but that's sort of the process. There's a lot more to it, but that's a very short-circuited way of describing the process.
No, that's a great way to describe it. So thank you for that. It is very technical, and I think to dumb it down for me, not for our listeners, obviously, but don't bury your head in the sand, right? It's the sort of communication or the narrative that we've had out to our customers and listeners of webinars for quite some time. We're obviously very engaged with the ATO ourselves and with ASIC. Don't bury your head in the sand, particularly if you get something as serious as a DPN. Alice, let's talk about some of the recent reforms, and Prue's sort of laid one up there for you around, small business restructuring and whatnot, which was obviously quite slow to take off, but looks like it's picking up in more recent times.
Oh, look, absolutely. Thanks, Patrick, and thanks, Prue. That was a great summary there. Can I just go back a couple of steps? And I understand that we've got quite a few accountants on the call today, and I think this is a real opportunity for accountants to educate their clients on the importance of having their lodgements done up to date. And I know it's obviously a big bugbear trying to get a lot of the information in, and for businesses who, try and get their lodgements done, and sometimes it's a bit of an inconvenience. But I think when you can really spell out the fact that if these lodgements aren't done, the next step can be that you're personally liable for this debt and you have no options but to pay it. It can actually give a really good platform for accountants to make sure that their clients are really aware of the services that they offer. I know that there are a number of accountants that actually have good subscription services where every month or every quarter they actually do the work for their clients. And the fact that just having those lodgements made, not necessarily the payments made, but the lodgements made, can provide their clients with so many different options at the end of the day, I think is a great platform for accountants to push forward. So sorry to sort of deviate there, but
that's good. Thank you.
Yes, so we do have, so we've got the options to go into liquidation, administration, or now the SBR, the small business regime as well. So this has been around, I think it was announced in September 21 and it came in January 20, or was the other way around, September 20 and came in 21. Like all the 3 years passed me by. But we've now had an actual review of how it's going, and it's probably being used a little bit more than we had initially expected, but the take up still hasn't been huge. And the reasons are there are certain eligibility requirements that need to be met before a company can enter into a small business restructuring regime. And these are being looked at the moment. But basically, the company needs to have less than $1 million in creditors. It needs to have their tax lodgement substantially up to date, and it needs to have their employee entitlements basically paid or provided for as part of the plan. So they're pretty big hurdles for many companies.
The tax one in particular, right? Because generally they're the last, if you're struggling from a cash flow perspective, it's the last one you actually pay.
Yeah. And again, it's not having the tax up to, it's having the lodgements up to date. So again, going back to because in many of the regimes that have actually gone forth and have got up, the tax office, I understand, has been the major, or if not one of the major creditors in those regimes or in those administrations. And my understanding is that the tax office has been quite supportive in the main, especially when they're COVID affected businesses. And it can be seen that the plan is really there to help the directors stay in possession of the company and work through those tough times. And I guess that in itself is the real basis of the small business restructuring. So in a liquidation, in an administration, the insolvency practitioner, someone like me, comes in and is appointed to the company and then basically is in control of what happens after that. And the directors sort of are put to the side. They need to comply with certain obligations and assist the liquidator, but they no longer have control over the company. And there's been a significant push that's now resulted in the small business restructuring regime where, maybe in especially smaller businesses, the directors know their business a bit better than a stranger that can come in. Maybe they can put together a plan and still remain in control of the company whilst the company can work its way out, basically under the supervision of a small business restructuring practitioner, which is a registered liquidator or a specially registered small business restructuring practitioner. And so that's basically a two-step process whereby a company will consult with a small business restructuring practitioner to formulate a plan. They'll give certain information to creditors, and creditors will vote on whether or not to accept that plan and then put that plan into action. So that's a new option. It's one that, again, we've had less than 100, my understanding, and over that period, but that's more than I think a lot of us thought we would have. And I think it's something that is here to stay. There's discussions about, does the limits, go up in terms of $1 million total debt is not a lot of money. There were some initial thoughts that it might have been $1 million in unsecured, and I think that's probably about right. But it is hard for a lot of companies to sort of work within those criteria. The other thing that has been brought in terms of alternative administrations is the simplified liquidation regime, which is basically just a creditor's voluntary liquidation light, as it were. So I think the directors have to sort of decide within the first sort of week of the administration if it wants to do or apply for a simplified liquidation. But the issue there again is that these same criteria apply. The lodgements need to be up to date. There needs to have not been any sort of administrations or restructurings of companies involving the director over the last 7 years. And as with everything, the more sort of constraints we have around it, the less likely they are to be taken up. So whilst we've got different alternatives now within the options available under the DPNs, one would wonder whether or not, if you're having issues around lodgement and payment of tax, you're going to meet the criteria that is required to be able to do a small business restructuring or a simplified CVL.
Yeah, fantastic. Thank you very much for that. And Prue, I'm going to come to you on the Clifton decision, but just a reminder to anyone who is listening in live on LinkedIn, please do ask questions as we go because we're keen to answer them. So you touched on it earlier. Can you give us a little bit more insight into the Clifton decision? It's obviously a big one.
Sorry?
It's obviously a big one.
Yeah, it's a big one because, to try and keep it really simple, because there's a lot of different, issues in that case, but to keep it really simplified, it was essentially the court found that directors that were entering into a payment arrangement, which previously would have remitted personal liability, that no longer occurred. So it doesn't mean that, if you're served with a director penalty notice, you can't enter into a payment arrangement, but it just means it doesn't stop the case, that it didn't stop that 21-day period running. So the directors are still personally liable. So that's why that early stage of engaging is so important. So it's quite a complicated decision, as I said. So that's probably the easiest way to put it, just that they cannot remit the personal liability any longer by entering into a payment arrangement. And
just to ask a follow-up question to that, essentially prior to that decision, did that mean if you started to repay, the 21 days sort of paused or restarted if you then stopped paying again?
Yeah, good question. I'm not sure whether you know the answer to that, Alice, but I think that, I'm not sure, but I think that's the case, that, but prior to this decision, if you were served with the DPN, no matter, if it was a non-lockdown DPN, one where you've already lodged but not paid, it would remit that personal liability. But this case was significant because it stopped that, obviously, being able to be an option. And so now, the 21 days does stop running. Yeah.
Look, and I think where there's a loophole to be found, people will find a loophole. So no doubt that was introduced for that reason.
Exactly. And then just to jump on to, I guess there are defences available to DPNs. So under the Corporations Act, there's, not the Corporations Act, I think it's the Income Tax Assessment Act. Correct me if I'm wrong, Alice, but I think that's right. The DPN defences. So I guess some loopholes that you might get around is, one of them is you were ill or couldn't take part in the management of the company for some reason, and that's sort of a complete defence that can be raised at that stage of the DPN, or even once legal proceedings are issued, because obviously you can't enter into one of those 4 options if you weren't taking part in the management of the company, or you were ill in hospital, or say your wife or husband or child, all those sorts of things can be taken into account. And the other defence is that you took, I find it an odd one, but that you took all reasonable steps. I don't know what the reasonable steps are, to do one of those 4 things. So you either tried to pay, or you tried to enter into, some sort of insolvency, which, you would think there's a lot of insolvency practitioners out there. So, it should be a fairly easy thing to do, but that isn't.
Over the last 2 or 3 years, there's been plenty of them eager for work.
Exactly.
Can I just interject there? I think
Yes.
I think that in itself can be whether or not you don't have the power. So, for example, if you've got a company that might have 3 directors or more, and you're wanting to put the company into administration, but the other 2 are in cahoots and won't let you, and you've passed a resolution at a meeting of directors to do that, and they won't let you do that. I think that's sort of an example. It might not be a complete example of where that might happen. Or similarly with a CVL, if you don't have a majority shareholding, even as a director, or your related entity doesn't have the majority shareholding and can't, make that happen. They can't put the company into a creditor's voluntary liquidation, but they've tried to. They've tried to call the meeting. They've tried to do the things. Maybe they have approached an insolvency practitioner, but they can't do that for one reason or another. I don't know that on its own, but I think that's an example that can fit into a scenario where you have tried all reasonable steps and been able to do it.
Yeah, that's a good one.
All right, that's great. Now, just talking about the obviously the ATO a bit. So, I think it was about 12 months ago they made a big song and dance around 50,000 DPNs preparing to be sent out, and a lot were. And I think to the ATO's credit, their communication, particularly over the last sort of 12 months since we exited COVID heavy, and I'll say we're in COVID light now. I won't say it's gone, because that'll cause the comment potentially to go a bit crazy. They gave a lot of sort of heads up that they were coming, and you need to reach out or you need to respond. They were making a lot more phone calls, got back into their normal collection rhythm. Obviously, media releases around 50,000 headline number of DPNs, and they started to actually make the phone calls. So they made sure that everyone knew. But despite that, I've got some numbers here from Assistant ATO Commissioner Claire O'Neill. They issued about 18,500 DPNs in 2022 to individual directors in respect of more than 13,500 companies. And what we know, obviously DPN very important, but also the ability for the ATO to lodge tax defaults now with credit reporting bureaus like ourselves. So essentially, if you owe more than $100,000, more than 90 days overdue, and you have no communication contact with the ATO, so you've buried your head in the sand, you can have a default registered against your credit file. So there's been about, I believe, about 500 of those have been registered. The final sort of tool in the ATO toolkit, which is wind-ups, liquidations, still remains firmly in the toolkit as far as I'm concerned. Keen to get, Alice, your thoughts on that. Obviously, the biggest creditor in Australia is the ATO, responsible for more than any other creditor.
Yeah, absolutely. And I think we will have all seen there's been a steep increase in insolvencies and in liquidations in particular over the sort of last 6 to 8 months, especially since this DPN regime has taken off. But the really important factor to note there is that there hasn't been many ATO instigated windings up where they've been the actual petitioning creditor. So normally what happens is the ATO goes into its debt recovery. There's either non-engagement or non-payment of debt, statutory demands issued, there's a default, there's a judgment, liquidations on the back of the judgment, and the tax office is the petitioning creditor. Very long story short, but that's sort of what happens. A practitioner gets appointed as a liquidator and we go there. And we find that historically has been a main driver in terms of those sorts of liquidation appointments. What's happened in the last sort of 8-ish months, and this is probably, Patrick, since we had the call for the 50,000, the DPNs that might be coming, and then again following the 29.5 warning letters that were issued, and then again the 18,500 DPNs that then sort of came about with that, was again, we've got these options. So when you've got an option for a non-lockdown DPN to either put your company into administration or wind it up, or be personally liable for the debt, I would suggest that more times than not, you're going to put the company as a director into a form of administration, and that's what's happened. So whilst the tax office hasn't actually been in the driving seat as the petitioning creditor doing all of those appointments, it has been instrumental in the increase of windings up, voluntary windings up through that period, merely by issuing these director penalty notices. That being said, I have noticed a little bit more by way of increase in debt recovery actions by the tax office that are leading to requests for consent from liquidators and trustees in bankruptcy. So we're clearly, at the last day of the first month of 2023, there's a lot more to play out, I think, in this financial year and obviously in the calendar year. But I do think that the ATO is probably not backwards now. If you're not engaging, then I think they know what process they're on. And I think that they feel quite justified in doing that. Not that I know anyone from the tax office, and that's not a line from them, but I think that's what we've been told for the last little while now. Engage with us and we'll help you. But if we're ignored, then we'll continue our process.
And Prue, any comments to add to that?
I can say that, I'm seeing what Alice is saying. Obviously, I get a daily list of, insolvency appointments across liquidations, applications and administrations. And, that's gone from sort of this to, that in the last 6 months. Is definitely scrolling down that list takes a lot longer. So certainly seeing that. And obviously the information around tax debts being reported to credit reporting bureaus as well, seeing that. And I think that's really helpful for credit managers and accountants on the line as well, to make sure that whoever you're dealing with, whether it be at the outset, whether you're approving credit applications and assessing credit risk, I think, having a report such as the CreditorWatch report with the ATO debts and the defaults is really helpful from a credit risk management perspective. And then along the line, obviously dealing with your customers, if there's a concern, if there's a non-payment, and then you do one of the, obviously obtain one of those reports, and then you can see there's an ATO debt. So I think, we're seeing a lot more of that, a lot more awareness around what's owed to the ATO. So, credit managers and accountants advising, and lawyers as well advising, can advise their clients about what might be a risk and whether they should continue with that particular customer.
Hopefully gone are the days of a customer going into administration out of nowhere when they've been paying you well and they owe thousands of dollars or millions of dollars to the ATO. So
all right. Absolutely.
We're right on 12 now, and I'm conscious of everyone's time. No doubt. I really appreciate both Prue and Alice. Thank you both for coming on and providing that insight. I doubt that this will be the last conversation we have around DPNs, and keen to continue the discussion. So thank you both for joining. And
thank you so much.
And thank you to everyone online as well for coming on. We know that it's time is precious, so we appreciate you gifting that time to us today. Go and enjoy lunch, everyone, and have a fantastic, healthy and prosperous 2023 as we get back into work after a glorious summer break, hopefully, that everyone had. So thank you, everyone, and we'll see you next time.
Thank you.
Thanks, everyone.